let's derive the cash flow statement. What? What is he talking about? Let's derive the cash flow statement. So there is something that we know that we can always start with as accountants, and that's the basic accounting equation. The basic accounting equation. Assets equals liabilities, I'm going to abbreviate, plus equity. I'm going to abbreviate that too. Okay? That is the starting point to derive your cash flow statement. Now, ultimately, the cash flow statement is looking for changes. It's not looking for this equation, right? We're looking for what's happening from a change perspective. So I'm going to alter this equation, and really we're just looking at the deltas. So the change in assets should always equal the change in liabilities plus the change in equity. And mathematically, that should make sense to everybody. So now let's start disaggregating each of these items. And we're not going to do a full disaggregation, but we'll just kind of give you an example disaggregation. So all of this is a change, and so some of the things we have in assets, we're going to have change, well, in cash. What other assets do we have? Well, we might have change in AR, accounts receivable. Change in inventory. Change in P, and E. We'll just go with that for the time being, right? You could have changes in prepaids, changes in intangibles, whatever's on the asset side. You're going to have changes, right? And that's going to equal my change in my liabilities. So what's a disaggregated liabilities? Well, we'll do a couple, right? So we're going to have change in accounts payable or any of the payables plus change in deferred revenue plus change in, say, long-term debt. Simple, right? So these are my changes. So these are all my changes in my assets. These are all my changes in my liabilities. And then we're going to add to this my changes in equity, and we'll keep it simple. So changes in owner's equity plus changes in retained earnings. Simple. We're keeping this simple. So we're just looking at the change in beginning cash, last year's end of the year balance versus this year's balance. Okay. This is getting exciting. Now the cash flow statement is focused primarily on solving for that. That's our focal point. So if that's our focal point, then we need to isolate this algebraically to one side of the equation, and then everything else should equal the change in cash. So what we need to do is we need to take these components of assets and subtract both sides of our equation by these items. Right? All we're doing is just simple algebraic manipulation here. Nothing too crazy, just simple. So we're going to subtract the change in accounts receivable, inventory, and PP&E. We're going to subtract from this side of the equation and subtract from this side of the equation. So after I do that, this is what I'm left with. This is now the new derived cash flow statement equation. Change in cash is now equal to, I'm going to put my liabilities here, so change in AP plus change in deferred revenue plus change in long-term debt plus change in owner's equity plus change in retained earnings. Okay? Because I've subtracted out this from this side of the equation, so the only thing that's left on this side of the equation is cash. And I've also subtracted the same amount, these same components, on this side of the equation. So, minus, I'll put a little parentheses there, so this minus, it will go throughout the entire part of what's in the parentheses. You know, we think about order of operations. Change in AR plus change in inventory plus change in PPE. This is the cash flow equation. This is what we got to get to. Right? This is the... Now, for your company, you may have more assets and liabilities and equity accounts. But if we had a very simple structure that I laid out here, we are ready to start putting together a cash flow statement. The question is starting to classify these things as either, any of these changes. We have to classify the changes as operating, investing, or financing. And that's our next step.